Welcome to the Royal Tax Podcast with your hosts, Megan Templeton, Royal Legal Solutions Consulting Attorney, and Royal Legal Solutions CPA, MBA, and CFO, Pete Schindele. Each week, they talk about how to take your tax and financial strategy to the next level and learn how to build and scale your real estate investing business in a way that maximizes your returns and minimizes your taxes. This is for informational use only. For direct questions, please contact us or your local tax CPA accountant.
All right. Well, guys, thank you as always. I think those groups are particularly valuable. You heard Brendan touch on it a little bit, is that he was in a group with folks he has been in a group previously with. So they're building those long-standing relationships. And that's one of my favorite parts of these shows is the community that is forming and meeting on a regular basis and making those connections where we can help each other get to the goals we're trying to reach. So for now, we'll go ahead and hop into it. So Pete, tell us a little bit about the topic today, bud.
Yeah, today we're going to focus on kind of tax deductions that you can take both on an S Corp and a C Corp, just to make sure you're getting all the deductions and benefits you can have to lower your taxable income. And then based on some feedback, we'll kind of discuss the little difference between the S Corp and the C Corp as well. So to start off, whether you're a sole proprietor and you don't have an LLC or you do have an LLC, you would use a Schedule C. And with an S Corp, you don't file that on your personal return. You will file that through an 1120S, which is a different tax form. And then that will issue a K1 that goes on to your personal return. So there's like the two differences right there. Both S Corps and C Corps, you will have to pay that 15.3% self-employment tax, half for the employer, half for the employee. One of the positive notes is, though, you are able to, on the sole proprietor, you are able to deduct half of that as a cost. So you pay the 15.3% out. You do get a credit of 7.65% to help offset your income. So on the sole proprietor, that is helpful because it does lower some of your tax burden. So that's for the C Corp. On the S Corp, what's nice about it, and that was mentioned earlier by Chris, and we'll do a presentation on when to go from a sole proprietor LLC to be elected to be taxed as an S Corp. Because what's nice about an S Corp is you do get issued a W-2 through the S Corp because it's a corporation. So you're still really paying that 7.65%. You've got the employee portion, the employer portion, but your W-2 wage, you can find a reasonable wage, out there on Indeed that might be significantly lower than what you're making as a sole proprietor. So let's say you're making $100,000 as a sole proprietor, you're gonna have to pay 15% self-employment tax on that entire amount. Well, if you run it through an S Corp, let's say you find a similar job duty that's paying you $40,000. Well, you pay that 15% on that $40,000. That remaining $60,000 then gets paid year end or quarterly as a distribution. So you get to avoid 15% on the self-employment tax on that portion. So again, we'll do a presentation later on this year about when to try to elect an S Corp. It's going to be different for every person, but that is kind of one of the major benefits is you don't have to take your entire wage as an S Corp, which allows you to avoid that self-employment tax of 15.3%.
Want more information? Join our community groups that exist to provide a space for like-minded people on a similar journey to learn, share, and network with real estate investing professionals and entrepreneurs. We meet weekly for an hour in Zoom to offer knowledge and accountability. Be sure to grab the link in our show notes.
So that's one big difference. Another difference between the S Corp and a C Corp is the home office deduction. So if I'm a sole proprietor and I'm filling out my Schedule C, I'm able to deduct my home office. A lot of people are interested in deducting their home office, and there's a couple ways you can deduct your home office. They have a standard method, which is about $5 per square foot, up to 300 square feet. So right off the top, through your Schedule C, you could lower your income by about $5 a square foot up to $1,500 if you decide to do the standard deduction. Or, and I won't go too more in depth on this to keep it high level, because this could take a whole half hour to hour to explain. But then there's also like the actual expense of the home office, where you take the proportion of the square footage of your office over your entire home. So if you had 100 square foot office that was dedicated space in your home, and you had a 1,000 square foot apartment, 10% of the costs would be your ratio that you could expense as home office. So rent, mortgage, insurance, utilities, and so forth, and depreciation. So that you can deduct on a Schedule C, but not really at an S corp as much. And another similarity between those are kind of the two big differences between the two right now. And again, depending on what route you want to choose, really is kind of a scenario you have to sit with your CPA or financial planner to kind of determine when it's correct to elect the right option to go to a C corp, or also whether to take the standard or the actual home office. Mm-hmm. Usually the actual home office gives you a higher deduction, which is going to lower your taxable income. One thing though that you can deduct on both is health insurance premiums. So if you're a sole proprietor and your wife or spouse or husband, if they do not have health insurance through their job, you can write off your health insurance, their health insurance, and your kids, if you have kids' health insurance, as long as they're not 27, you can expense that all through your sole proprietorship and LLC. As well, in the S corp, you can expense your health insurance premiums. So, these are just ways to make sure if you are in any one of these situations that you're getting those deductions, because you're already paying them, and let's reflect that on your tax return and as expenses, so we can lower your taxes. Another thing you can deduct on both is mills. Every dollar you spend on mills that's business related, historically it's been 50% that you're able to deduct. Under the new CAA, the Consolidated Appropriations Act, you're actually going to be able to deduct 100% of your business mills, starting January 1st, 21 through the end of 22 of this year. So instead of getting that half, you'll be able to deduct 100% for this year and last year.
Thank you for listening to the show today. If you're feeling overwhelmed with taxes as they relate to your real estate business and investments, or you're unsure if you're doing your accounting correctly, fill out our 5-minute quiz. With the information from this quiz, you'll schedule a meeting with a Royal Legal Solutions advisor who will provide you with powerful tax-saving strategies on your first call. Go to www.royallegalsolutions.com/tax to fill it out.